if you're thinking about buying an investment property and wondering how does that work with a mortgage when you're buying an investment versus a primary resident, here are a few things that you need to know. Number one is the down payment. When it comes to down payment for investment property versus primary resident, with primary resident, you can put as little as 3% down. With investment property, the minimum down payment is 20%. And typically I'll tell my client that usually you should account for about 25% for down payment because you'll get a much better interest rate. And then speaking of interest rate, which is my second point, the interest rate on an investment property is going to be higher. They're typically at least 1 point higher. So for example, if you're buying a primary resident, 30-year fixed, your rate is 5.5%. Then if you're buying the exact same property for investment purpose, it will be 6.5% would be an example. And of course, it does depend on your income and your credit score too, and that might affect the interest rate a little bit. But do account for at least 1% higher. And then third is also your credit score, of course, and your income. They do take into effect the same way your credit score, how good you are with it, and your income. And of course, now not only your income has to be able to carry you for your primary resident, it has to be able to carry you for the investment property as well. And if this is your very first investment property, they may require that your income alone have to be sufficient for both the primary resident and the rental. If you have some experience already with investment property, if it's your second or third, many company will allow you to use an estimate rent rate in order to count that toward your income as well. So those are the three main things that you need to know when you are buying investment property versus a primary resident. Last and not least, there are two ways to qualify for an investment mortgage. The first one is to qualify based on the borrower income. And the second way is to qualify based on the investment property ability to generate income. So the first method is very common and most borrower will go for that. And it's very similar as if you to the way you borrowing for a primary resident. The lender will look at your credit score, your income, your debt to income ratio, all of that, and factor that in to give you the loan for the investment property. And typically this type of loan will be a little bit higher than one that is for investment property, but it is going to be lower, meaning the interest rate will be lower than to qualify for the investment property based on the income of the property. So the second way, when you qualify to get a loan for investment property based on the income of the property, meaning that they'll look at to see how much can this property generate in terms of revenue, and then how much expense does this property cost. And as long as the revenue or the rent can cover the expense, then they'll be able to give you the loan. Of course, on the downside is that it does cost a little bit more, because there are more risks to the lender in these situations. However, that's where it's important to find property that makes sense. So as long as the property can generate income and bring in a positive cash flow, it absolutely makes sense to go with this type of loan, even if it is going to cost you a little bit more in interest rate.